Next question. ABC company is considering, highlight the portion, a new sales strategy that will be valid for next 3 years. So a company is considering adopting a new sales strategy and it will be valid for 3 years. They want to know, highlight the portion, value of the new sales strategy. Following information relating to the year which has just ended is available. Means basically we have been provided with year 0 information. Income statement, in that sales is provided 20,000 rupees, gross margin is 4,000 rupees, administration, selling and distribution expenses 10%, that is 2,000, earning before taxes, income tax at the rate of 30%, profit after taxes. Balance sheet information is provided to us. In that, fixed asset, current assets and equity share capital is given to us. If it adopts new sales strategy, sales will grow at the rate of 20% per year for 3 years. Gross margin ratio, asset turnover ratio, capital structure and income tax rate will remain unchanged. Depreciation would be 10% of the net fixed asset at the beginning of the year. The company's target rate is 15%, means cost of capital is given. Determine incremental value due to adoption of the strategy. So if the company is adopting the new sales strategy, what will be the increase in the value that is required to be calculated? I request all of you to go through the question, please. Dear students, as far as the valuation is concerned, understand, as far as the valuation is concerned, for that say we have the different methods of valuation. Do not write anything, let me explain to you. We have a term called valuation of the equity and we have a term called valuation of the firm. As far as the valuation of the equity is concerned, we have net asset method, we have earning capitalization method, we have the free cash flow for equity method, and so on, the different methods that we have for the purpose of the valuation of the equity. As far as this question is concerned, the question says that you are required to compute value of new strategy. What does it mean, friends? It means that you are required to make the calculation of the change in value of the equity with new sales strategy. Over here, the question says that, so this is the way you have to understand it. You have to compute that, say, what is the change? What is the difference between the value of the equity with new sales strategy and existing? That is what we are required to calculate. This is the first thing that I want to tell you. Second point, listen carefully. For the purpose of valuation, which method is supposed to be adopted? See, you have been provided with the information that the sales is going to increase. Asset turnover ratio will remain same. Means the assets of the company will also increase along with the increase in the sales. Then we have been provided with the information about depreciation. It means that the sufficient information is given to us with which we can make the calculation of free cash flow for equity. So what happens that we are required to make the calculation of free cash flow for equity, and based on that we are required to compute the value of the equity. Yes. Over here we understand that we are required to compute the value of the equity with new sales strategy and again value of the equity with, that is, if at all the new sales strategy is not adopted. And that is the way we are required to find the change. These things are implied to understand whenever such kind of information is provided to us. Now, how to make the calculation of free cash flow for equity, and discounted value of the same is the value of the equity. So how to make this calculation is now what we are going to discuss. Now friends, for the purpose of calculation of the free cash flow for equity, it's extremely simple. We are required to calculate profit after taxes plus depreciation, that is a normal cash flow that we have, minus capital expenditure, minus working capital increase. That is the way free cash flow for equity will be found. You may recall a kind of, say, the capital budgeting that say you do. That is the way we are supposed to do answer over here. Profit after taxes plus depreciation. Why? Because depreciation is a non-cash item. In calculation of the profit only, so the operating items are taken into account. Any capital expenditure is not considered, so it is deducted later on. Again, in that the working capital adjustments are not made when we compute the profit. That is the reason it is required to be adjusted later on. It may be increase in the working capital, it may be reduction in working capital. If it is reduction, then in that case it will be added. But usually for an ongoing concern, when it is expanding its business, it is always going to be the increase in the working capital. That is the way the free cash flow for equity is supposed to be calculated. Now friends, how to make the calculation of the free cash flow for equity? Let us have understand. See, first of all, what happens at say, as per the given information over here, in which they have provided that say the asset turnover ratio is going to remain same. So using this information, we are required to compute that what is the investment that we have to make in the asset. This is what say we are required to calculate. So all these things will be used by me now for the purpose of giving explanation. First of all, I am giving you a detailed explanation, but of course detailed explanation something that will be very time consuming in examination. So then I will give you a shortcut explanation. So both things I am going to provide you. I request all of you to pay attention. Do not write anything. See, the sales of the company is given to us an amount of 20,000 divided by the assets, that is an amount of rupees, in total 12,000, that is 8,000 plus 4,000. So the asset turnover ratio is 20,000 divided by 12,000, that is 1/2. This is what we understand. Now at the end of the first year, what will happen? Sales of the company will increase by 20%. So use your calculator. 20,000 plus 20%, it comes to 24,000. So sales upon assets is equal to 1/2. So the assets of the company is equal to sales divided by 1/2. What is the sales of the company? 24,000, which I just explained to you, divided by 1.67 or 6666, like that. So divided by 1/2, that comes to 14,400. It means that by applying common sense, we understand that the assets of the company will increase at the rate of 20%. The reason for that is very simple. Sales of the company is increasing by 20%, so assets of the company is also increasing by 20%. This will increase at the rate of 20% for first 3 years, and afterwards it will not increase, because we assume that the company is going to do business forever. So from 4th year onwards, sales of the company will become stagnant. That is what we assume. So read and answer the question. calculation of value of equity using free cash flow for equity method if new sales strategy is adopted. In the write-down, working note number 1, calculation of fixed asset addition and depreciation from end of year 1 to end of year 4. That is the way we are required to make the calculation of answer. Now let us have understanding how to do answer. We start with the opening balance for year 1. In that it is 8,000. So opening balance is 8,000. Now dear students, you can see that the question provides that depreciation would be at the rate of 10% of net fixed assets at the beginning of the year. So in that case, we will mention over here by depreciation. It would be 10% of 8,000. That is an amount of 800. And the closing balance, as per the detailed explanation given by me, it is 8,000 into 1.20 raised to 1, in a way that said that there is a growth of 20% in the sales and asset turnover ratio is same, so the assets will also increase by 20%. So in that case it would be 9,600. So the credit side total is 800 plus 9,600, that is 10,400. Debit side total would be again 10,400. From that, the opening balance of 8,000 would be deducted to calculate the purchase. So the purchase would be 2,400. That is what we are supposed to calculate for the first year. This is what's the working that we have for the first year. Similarly, we will do for second, third and fourth year. Second year opening WDV is 9,600. Second year depreciation would be in the second year it would be 9,600 into 10%. So depreciation will be 960. Closing balance will be 9,600 into 1.20. That comes to 11,520 plus 960. So the credit side total is 12,480. Debit side it is 12,480 minus 9,600. So it is 2,880. Next, for the third year, again the depreciation will be calculated. The closing WDV at the end of the second year is opening for the third year. 11520 into 10 percentage. That is 1152. The closing balance will be 11520 into 1.20. 13824 plus 1152. So 14976. So 14976 minus 11520. So it is 3456. For the fourth year, the opening balance would be 13824. That is closing at the end of the third year. Now closing for the fourth year would be 13824. Depreciation will be 13824 into 10 percentage. So what will happen? The amount of the depreciation is 1382.40 and opening and closing are same. Why? Because the sales of the company will become stagnant. Since the sales of the company will become stagnant, so the assets of the company will also become stagnant. So 13824 plus 1382.4. So 15206.4. 15206.4 minus 13824. So 1382.40. This is the way we are required to make the calculation from end of year 1 to end of year 4. Please take down answer. Second working note will be calculation of working capital addition from end of year 1 to end of year 4. Friends, over here the sales strategy is adopted for 3 years. Yet we are making calculation for 4 years because from 4th year onwards for perpetuity, whatever the cash flows which the business is going to generate will be discounted to the 3rd year end. That is the reason. So I request all of you to make the calculation of the working capital addition from end of year 1 to end of year 4 and put your answer in the chat box. One more clarification that I want to give is that before we proceed for the working capital working note, we can see that the sales of the company is 20,000 and fixed asset is 8,000. So we can have a kind of understanding like this. Instead of the total asset turnover ratio, you can compute the fixed asset turnover ratio. As far as the fixed asset turnover ratio is concerned, it can be calculated as sales upon fixed assets. What is the sales of the company? 20,000. What is the fixed asset? Fixed asset is 8,000. So what is the answer? Answer is 2.50 times. That is the fixed asset turnover ratio. Now, year 0, year 1, year 2, year 3, year 4. You can understand something like this. Sales is 20,000. Then it increases by 20% to 24,000. Further 20%, 28,800. Further 20%, 34560. And then it will not increase. So it is 34560. So fixed asset. 20,000 divided by 2.5. It is 8,000. 24,000 divided by 2.5 once again. It is 9,600. 28,800 divided by 2.5 is 520. 34560 upon 2.5, 138240, 13824, and again it will be 13824. So basically we understand that say beyond the third year, the opening fixed asset and the closing fixed asset would be same. Why it would be same? Because the sales of the company is becoming same. That is what we understand. Working note number two, calculation of working capital change from end of year 1 to end of year 4. Why fourth year? Because we understand that say from fourth year onwards, whatever the perpetual cash flow is required to be say discounted to the third year end. What is the working capital? Right now that we have it is 4,000. So we understand it is year 1. Working capital will increase to 4,000 into 1.20 raised to 1, that is 4,800. So working capital change, in that case it is 4,800 minus 4,000, that comes to 800. In the second year, 4,800 into 1.20 raised to 1 once again, so that comes to 5,760 minus 4,800, that comes to 960. Third year, 4,800 into 1.20, sorry, 5,760 into 1.2, 6,912 minus 5,760, 1,152. Fourth year, there is no change in the sales, so the working capital will also remain same. So afterwards we don't have to make any investment in the working capital. This is the way we are required to compute the answer from end of year 1 to end of year 4. Please take down answer. Working note number 3, calculation of free cash flow for equity. Free cash flow for equity. In bracket I am writing year 1 to year 4. Let us have understanding that say how to make the calculation. This is going to be an important working note. Dear students, over here sales increases, so along with that so the gross margin will also increase. Administration, selling and distribution expense will also increase, so PBT will increase. With that the income tax liability will increase, so profit after taxes will increase. So what will happen? Profit after taxes will increase at the rate of 20% from end of year 1 to end of year 4. So what will happen, dear students? It is end of year 1 to end of year 3, I'm sorry, and fourth year it will become same. So for the first year, listen carefully. Profit after taxes will be taken as 1400 into 1.20 raised to 1. That comes to 1680. Now, to that depreciation will be added. First year depreciation is 800. This is the depreciation. Next, we will mention capital expenditure. At the end of the first year, capital expenditure is 2400 and working capital is 800. Both of them would be deducted. Capital expenditure is 2400 and working capital change, that is working capital increase precisely, it is an amount of 800. So profit after taxes plus depreciation minus capital expenditure minus working capital increase, that will give us free cash flow for equity 1680 plus 800 minus 2400 minus 800, that comes to 720. This is for end of year 1. Similarly, from second year to fourth year, it will be calculated. Try to do further answer on your own and put your answer in the chat box. So second year, it will be 1680 into 1.20 raised to 1. It is 2016. Amount of depreciation. For the second year, it is 960. Capital expenditure, it is 2880. And working capital is 960 increase. This is the way we are required to do answer. Okay. So the purchase is 2400. Then it is 2880, 3456 and 1382.4. So for the third year, it is 3456 and for the last year, it is 1382.40. The profit after taxes will be 2016 into 1.2 raised to 1. 2419.2. For the fourth year, it will be same 2419.2. Next is depreciation. This is the depreciation. Third year, it is 1152 and last year it is 1382.4. Double 152 1382.4. As far as the working capital is concerned, it is 1152 is an amount of investment. Afterwards, there is no investment to be made. So finally, we will have the working of the answer like this: 2016 plus 960 minus 2880 minus 960. So it is 864 negative. 2419.2 plus 1152 minus 3456 minus 1152. So 1036.8. For the fourth year, we understand it is 2419.2. That is the way we'll have the free cash flow for equity. It means, friends, we have to understand from the given, that is from the calculated answer, that say for the first 3 years, we have to make investment. And then from fourth year onwards for perpetuity, we will receive an amount of the cash inflow. Now working note number 4. Calculation of P3. What do we understand with the term P3? P3 means from fourth year onwards for perpetuity, whatever the cash flow that you are going to receive, All of them have been discounted to the third year end. So friends, we will be making calculation like this. Free cash flow for equity for the fourth year divided by K minus C. What is the fourth year cash flow? 2419.20 divided by cost of equity. What is cost of equity? That is 15 percentage. And what is the growth rate? Growth rate is 0. Why? Because it is going to remain same from fourth year onwards for perpetuity. So the final answer would be like this: 2419.2 divided by 0.15, 16.28, and this is going to be received year 3 end. Okay. Now we have got the substantial values with which we can compute the value of the equity. We have got the first year cash outflow, second year cash outflow, third year cash outflow, fourth year onwards for perpetuity, whatever we are going to receive, its discounted value in the third year. All these will be discounted to year 0 to compute value of the equity using free cash flow for equity method. So write down answer. Calculation of value of equity. In that, we will work out the answer like this: first year, second year, third year. Free cash flow for equity, cost of capital is 15 percentage and present value. So it is 720 is outflow. Then 864 is again cash outflow. Then it is 1036.8 is outflow. Plus 16128. So 15091.2. It will be discounted at the rate of 15 percentage. Its present value will be calculated to compute the value of the equity. This is what we understand. So 15% is the discounting factor. First year factor is 0.8696. Second year it is 7561. Third year it is 6575. Now based on that, we will make the calculation. 720 into 0.8696. So 626.11 outflow. 864 into 0.7561. So there is again cash outflow 653.27. 15091.2 into 0.6575. That is cash inflow. 9922.46. Total of all of them is value of equity. So the final answer comes to 8643.08. That is the value of equity. This is the value of the equity with new sales strategy. So giving a summary of the working that we already have done for calculation of the value of the equity with new sales strategy. The first working note is calculation of the depreciation and work, that is capital expenditure from end of year 1 to end of year 4. Importantly friends, the question is providing that the asset turnover ratio is remaining same. So if at all we compute the fixed asset turnover ratio, it is 2.5 times. So if at all the sales increases and that 2.5 is remaining same, then the fixed asset will be calculated on yearly basis. That is what we understand. Then the second working note is very simple, calculation of the working capital change from end of year 1 to end of year 4. In that, say for the first 3 years, say there is an addition of the working capital. From fourth year onwards, say there is no addition of the working capital. Why? Because we understand that, say, the sales of the company is remaining stagnant. Free cash flow for equity, that's the way we do a kind of simple capital budgeting question. Profit plus depreciation being non-cash item minus capital expenditure minus working capital increase. That is the way the free cash flow for equity is found. Fourth year onwards for perpetuity, whatever you are going to receive, all of them are discounted to the third year end. That is P3. Lastly, the value of the equity, in which first 3 years cash outflow. Means you have to understand that, so you need to invest if you expand your business for the first 3 years. Fourth year onwards, you will be able to get the cash inflow. All of them are discounted to the third year end. Net will be discounted in present value term to compute value of equity. Next is red on heading, calculation of value of equity comma without new sales strategy. So let us have understanding, that's how to make the calculation of this answer. I request you to write down answer along with me. Working note number 1, calculation of fixed asset purchase and depreciation for year 1. In that, particulars amount opening balance is 8,000, closing balance would be 8,000 itself. Why? Because we assume that, so the sales is not growing, so in that case the fixed asset will remain same, because the asset turnover ratio has to be kept same. By depreciation, it is 800. It is 8,000 into 10%. So balancing figure on the debit side would be purchase. That is 800. That is found as balancing figure. Credit side total is 8,800. Debit side total is again 8,800. So now fixed asset purchase is found as balancing figure. Please write down answer. Now friends, there is no working capital that is not required to be prepared for working capital addition, because the sales is same. Then in that case, there is no investment to be made in working capital. Next working note will be calculation of the free cash flow for equity. Working note number 2, calculation of free cash flow for equity. In that, year 1, profit after taxes is 1400. That is the sum. Sales same, so everything same story. Add back depreciation. It is an amount of 800. Less capital expenditure. It is again 800. No working capital change, so I am not writing it. So in that case, we understand free cash flow for equity will be 1400. This will be for end of year 1 and it is going to remain same for perpetuity. Next, we understand is valuation of equity. It will be calculated as profit after taxes divided by cost of capital. I'm sorry, free cash flow for equity divided by cost of capital minus growth rate, but over here there is no growth rate information. So it is 1400 divided by 0.15. That comes to 9333.30. This is the way the value of equity is calculated. Now friends, over here you can logically understand that whatever the depreciation itself would be the fixed asset addition. There is no change in the working capital, so it is 0. So what will happen technically, whatever is the profit itself is a cash flow. So this value of the equity can be calculated directly. You can calculate that directly as profit after taxes upon cost of capital. What is profit after taxes? 1400. What is the cost of capital? 15%. So what is final answer? 9333.30. This is the way directly the profit after taxes can be discounted to calculate the value of the equity. And very importantly friends, this method of the presentation is also acceptable in examination. So instead of going with this detail, you may do this shortcut method for the purpose of calculation of answer. Now the final answer is calculation of incremental value of equity with new sales strategy. In that we understand new value minus current value. What is the new value? New value is 8643.08 and the current value is this much, 9333.33. So the answer will be found like this: 8643.08 minus 9333.33. So the final answer is going to be negative 690.24. It means that, say, if at all we adopt the new sales strategy, value of the equity is falling down. So we understand that, say, the decision is that the new sales strategy should not be appointed. Should not be adopted. Friends, if at all the new sales strategy is not adopted, this 1400 is the cash inflow at the end of year 1. The same is discounted in present value term. So this value of the equity is of year 0. So write down decision. New sales strategy should not be adopted. That is the decision.